Well, there are many good trading entry setups out there, but few of them stipulate where or when to use them. Sure, some of them might use another indicator as a filter, but there's not always enough to consistently increase the probability of a setup. But if you can identify where a market has the most directional potential energy, you will find high probability trading setups. Now, the markets have a varying degree of potential to make a concerted move in a single direction, depending on a variety of factors. Now think about this for a moment. If a trader believes there's a good chance for a directional move from a particular price, they may decide to take a trade if they get a setup and see what they need in order to be convinced that the opportunity is a good one. If many traders believe in an opportunity, the chances that their combined action will precipitate the expected move are far greater. Now, of course, directional moves can start from anywhere. However, they tend to start from key prices and times. For example, consider a market that's been trading in a range for the last week or so. It's currently trading towards the upper end of the range, and there's no particular reason, such as a news or economic data that's just been released, to believe that there's an imminent change. At the high of the range, there's the maximum potential for price movement possible without the need for the balanced ranging behavior to change. In this scenario, it's quite likely that there are going to be many traders who are persuaded by the location and the fact that there's not been a change in the context which created the recent range to take the opportunity. Doesn't mean that they're right, but if they are, they should get a nice move for them, and if they're not, well, they don't have to risk too many ticks in order to find out. If you take trades when a market is poised like this, you're maximizing the probability of your particular setup. Let's look at some examples of where and when a market might have a decent amount of potential directional energy. Number one, the primary session open. For many markets, the primary session open is naturally a time when there's a good chance to see a decent move. This is because participants are at their most active at this time. You can easily see this in a volume or range heat map, such as this one for crude oil. In particular, if a market is opening some distance from where the majority of the prior session's trading activity executed, either the market is going to correct and retrace back to this zone, or there's a reason why it's moving away and the move could continue. Number two, session and range gaps. In the same way, a market that is gapped away from the closing price, ideally beyond the high or low of the prior session, is showing that either it's moving strongly in that direction and is likely to continue, or traders have gotten a little bit ahead of themselves and will need to cover their positions as the market retraces the gap. In general, gaps are more prominent when charting the primary market session. They also tend to be the most important. Once a gap starts to close, it often closes or at least pushes a significant way. A failed test into the gap and a new extreme on the opposite side for the day often leads to a gap continuation. Now here's a chart with two examples in the ES, one gap close and one gap continuation. Number three, an impulse move. When you get a strong move in a market, there's often at least a secondary attempt in the same direction, following the pullback. Recognizing this, a trader can look for a setup to take advantage once the pullback starts to roll over. The caveat to this is that you need to understand what a big move is to the time frame that you're personally trading. A 20-tick move may be a huge move on a 233-tick chart for some products, but if you're trading a 610-tick, it might be the norm. Do stat work in Excel so you know what's abnormal. Number four, balanced markets. Balanced or ranging markets have at least two reliable places where something is bound to happen at. These are the extremes of the balance. This can mean the high and low of the range, or like in the FTSE example below, a pattern which defines the balance. These are where either the market decides it wants to remain in balance, in which case there's plenty of room to trade back into, or it decides to break out of the recent balance and explore different prices. In both cases, there's plenty of scope for a large directional move. The point to recognize with balances is that they are far more reliable in their action when they're based on a longer time frame. I tend to like looking for a balance over several days, at least to find places where a big move could happen from. The FTSE example here has a 2-month balance. You shouldn't expect that a strategy will work in every location, every moment in time, even if it does have a high win rate. By targeting trades that occur when a market has a high level of directional potential energy, like some of the examples discussed here, and staying out of the noise, you're adding a reason for other traders to get behind you, and you're targeting high probability trading setups. Combining a good entry setup and technique with good location can give your strategy the best chance of generating winning trades